Hey everyone, welcome to today's Explainer. So today we're tackling a massive trap that so many people fall into. You know, the one throwing money at the stock market like it's a slot machine, just hoping for a quick jackpot. But as our sources reveal, there's a fundamental truth here. Building real wealth, it's not about picking the next hot stock or trying to time the market. It's actually about following a strict mathematical sequence. There's literally an optimal order for investing your money, and getting this right can save you tens of thousands of dollars over your lifetime and seriously accelerate your path to financial independence. So let's dive into this sequence and see exactly how it works.
Think of your financial journey exactly like building a house from the ground up. Here is our blueprint for today. 1. Fixing your broken foundation. 2. Curing high-interest financial cancer. 3. The guaranteed 100% return. 4. The tax optimization zone. 5. The ultimate secret weapon. And 6. Entering the Wild West. Let's get into it.
Look, most people want to skip straight to the fun stuff. The trendy ETFs, individual tech stocks, maybe the latest cryptocurrency. But asking those questions before you've mastered the basics, well, it's like asking whether you should buy a Ferrari when you don't even have enough money to fix the transmission in your current car. You absolutely cannot skip the unglamorous foundational work. It's what actually matters.
And here is the terrifying reality of where most people's foundations are currently sitting: $500. According to recent data, that is the median amount Americans have saved for emergencies. $500. I mean, that's less than most people's monthly car payment. And alarmingly, it's actually down from $600 just a year ago. 1 in 3 Americans doesn't have an emergency fund at all. This means they are completely exposed. You can't build a lasting financial empire if a single unexpected flat tire forces you into debt.
Step 1 of investing: fixing your broken foundation.
Before investing a single dollar anywhere else, you have to address this vulnerability so you aren't building your wealth on quicksand. Now, you don't need a massive pile of cash on day one. Step 1 is just to save your first $1,000 as quickly as possible to cover minor emergencies. Step 2 is building that up to 1 full month of living expenses. And finally, step 3 is expanding that to 3 to 6 months, depending on how stable your job is. This isn't just about cash, right? It's about creating a psychological safety net. When life throws you a curveball, this fund ensures you never have to sell your hard-earned investments in a panic or rack up high-interest debt just to survive.
Get this, recent research from Vanguard actually found that people with at least $2,000 in emergency savings had financial well-being scores that were 21% higher than those without any emergency fund. 21%! That was the single largest boost linked to any financial factor they measured. $2,000 isn't necessarily life-changing money, but the psychological impact, the peace of mind of having that buffer, it's absolutely enormous.
Step 2 of investing: curing high-interest financial cancer.
High-interest debt is an absolute wealth destroyer. It will completely negate any brilliant investment choices you make later on. Just notice the sheer mathematical mismatch here. Credit card debt right now carries an average interest rate of over 22%. Carrying this debt while trying to invest in the stock market is mathematically like trying to run a marathon with a backpack full of rocks. If you have $5,000 in credit card debt and only make minimum payments, you'll pay nearly $2,800 in interest over 5 years. Every single dollar you use to pay down that 22% debt is essentially earning you a guaranteed 22% return. That is way better than Warren Buffett's long-term average. To cure this financial cancer efficiently, we use a highly specific strategy called the debt avalanche method. Basically, you list all your debts, pay the minimums on everything, and then throw every single extra dollar at the debt with the mathematically highest interest rate. While some people do prefer the debt snowball method for those psychological quick wins, paying off small balances first, the avalanche method is the most efficient, mathematically sound strategy for clearing out this debt before investing another dime.
Step 3 of investing: the guaranteed 100% return.
Okay, so there is exactly one massive exception to prioritizing that high-interest debt. If your employer offers a matching contribution to your retirement plan, contributing enough to get that full match is priority number 1. This is literally free money lying on the ground. Think about it. An employer match is essentially a guaranteed 100% return on your investment up to their limit. Even if you're carrying credit card debt at 22%, getting an immediate 100% return on your money makes overwhelming mathematical sense. So you contribute just enough to get the full match and then immediately redirect all your extra cash back to the debt avalanche.
Step 4 of investing: the tax optimization zone. All right, our emergency fund is set, the high-interest debt is gone, and we are grabbing our free employer money. This is where we need to strategically lock out the IRS so our money can compound efficiently. The very first move here is maximizing your individual retirement account, or IRA. Notice I said IRA, not going back to put more into your employer's 401k just yet. Why? Because IRAs give you far more control over your investments and typically offer much lower fees. You have a choice between a traditional IRA, where you get a tax deduction today but pay taxes later, or a Roth IRA, where you pay taxes now but your withdrawals are totally tax-free in retirement. Generally speaking, young earners in low tax brackets love the Roth, while high earners looking to reduce current taxes prefer the traditional. For 2025, the contribution limit for an IRA is $7,000 or $8,000 if you're 50 or older. This is your immediate target. You want to hit this ceiling before moving forward. Over decades, utilizing these lower-fee, tax-advantaged accounts instead of the expensive corporate 401k options can literally save you tens of thousands of dollars. Step 5 of investing, the ultimate secret weapon. Once that IRA is maxed out, if you have access to this next account, you are in serious luck, because it functions like a financial Swiss Army knife. I'm talking about the Health Savings Account, or HSA. Now, you do need a high-deductible health plan to be eligible for this, but if you are, the HSA offers a rare, incredibly powerful triple tax advantage. First, you get a tax deduction when you put the money in. Second, the money grows completely tax-free while it's invested. And third, withdrawals for qualified medical expenses are tax-free. It is literally the only account that gives you a tax break on the way in, during the growth phase, and on the way out.
Let's just look at the stunning math here. If you were to max out your HSA contributions for 30 years and achieve a fairly standard 7% annual return, you could build a balance of over $400,000 completely tax-free, specifically for medical costs in retirement. Considering the average couple retiring today will spend over $300 grand on healthcare during retirement, this account is an absolute lifesaver.
But to really supercharge the HSA, you use this ultimate strategy. Step 1, max out the HSA, but actually leave the money invested and pay for your current medical bills out of pocket today, assuming you can afford it. Step 2, keep all those medical receipts. Why? Because there is no time limit on when you can reimburse yourself. Step 3, decades later, you submit those old receipts and pull the heavily compounded money out tax-free. You just let the market do the heavy lifting while you hold on to the receipts. It's brilliant. Only after you've conquered the IRA and the HSA do we finally return to the employer 401k. Think of this as putting the final roof on our tax-sheltered house. You go back and push your contributions all the way up to the $23,500 limit for 2025. Between the IRA, the HSA, and the 401k, you're shielding a massive amount of your wealth from current taxation, allowing it all to compound undisturbed. Step 6 of investing, entering the Wild West.
After all those carefully structured steps, we finally reach the taxable investment account, the place where you can trade options or speculate on crypto. Ironically, this is where most novice investors incorrectly start. The reason starting here is such a massive mistake is because of a silent killer called tax drag. Tax drag is the compounding loss of wealth in taxable accounts because the IRS taxes every single dividend payment and every capital gain along the way. Investing in a taxable account before you've maxed out your tax-advantaged accounts is literally like trying to run a race while someone continuously throws sand into your shoes. It just slows you down immensely.
Let's look at exactly how devastating that sand in your shoes can be. Let's say you invest $10,000 annually for 30 years. In a tax-advantaged account earning 7%, you'd end up with roughly $944,000. But in a taxable account with the exact same return but paying taxes along the way, you might end up with closer to $700,000. That is nearly a $250,000 gap caused entirely by tax drag. So, let's recap this ascending staircase, this perfectly structured blueprint for your wealth. 1. Build the emergency fund. 2. Kill high-interest debt. 3. Grab the employer match. 4. Max out that IRA. 5. Max out the HSA if you can. 6. Finish maxing the 401k. And 7. Only then fund your taxable accounts. True, lasting wealth is generated by relentlessly following this exact, unglamorous order.
Which leaves us with the most important question for you to answer today. Are you building your financial house on a cracked foundation? Take a close look at your own investment order. Are you out there chasing flashy stocks while carrying credit card debt? Are you skipping the HSA? Do the boring stuff first, secure your foundation, and your future self will absolutely thank you. Thanks so much for joining me on this explainer, and I'll catch you next time.